there is absolutely risk. All that money, if you don't close on the deal, you should get some of your earnest money back. Hopefully in today's environment, you get it all back. That's one nice thing I like about how the environment has shifted, because we did a couple of deals where that 100, we would have lost all 100.
Welcome to The Conscious Investor. Let's get started. Conscious Investor, welcome back. I'm so excited to have you here. And you know what? You keep writing those reviews and it keeps putting wind in my sails. And I am so grateful that you're taking time to do that. I think we're at 109, maybe 110 reviews now. I'm sorry. You can hear it. You can hear that my voice is nasally. I've come a long ways, so now I don't feel self-conscious about that, right? But anyway, I've got a little bit of a head cold, a little bit of a fog going on, but I am absolutely excited to share this time with you, because our goal here through the Conscious Investor podcast is support you, right? We want to help give you the power to make your next step. And that next step looks different for each of us. And so I've brought on a really good friend of mine. You know that I love breaking bread with people. It was so much fun earlier this year, just like meeting Lee in person and breaking bread in Columbus, Ohio with some other fellow, apartment investing friends, and talking shop and talking life and everything like that. But anyhow, I just want to welcome Lee to the show. Lee, thank you so much. Thanks for being a friend, and thanks for coming on the show.
Yeah, right back at you, Julie. Thank you for being a great friend to me, and I'm really excited to be on your show.
Yeah, it's really great. And, Conscious Investor, the great thing about the apartment investing community is that there's a lot of crossover in this. And so it's been fun. My husband and I hopped on a call. I mean, this is probably 2 years ago now, I think, Lee, with you and your wife, Hannah. And, it's just kind of nice to know, it's not just business, because we have our businesses for a purpose, and our families are really a huge part of that purpose.
Right.
Gosh.
Yep. Yeah, I agree.
That's so great. So Lee, we are going to discuss passive investing, but we're going to discuss passive investing with a twist. And this is one of those twists that I don't know that a lot of people who are pursuing their own passive investing realize, that active investors like yourself and I, we invest passively also. And sometimes we even invest passively in our own deals. What? Yes. So let's just go ahead and crack that open, and let's just share about what does that look like for you?
Yeah, good question. So I love real estate, and I like doing it actively, doing it full time, and hopefully we do well enough at it, because it is our job. So we do take an acquisition fee. There's different ways we do take an asset management fee. So there's ways we can kind of make money today. And then on some of the deals we owned a while ago, if we do really well and we sold them, then we can have some money. So just like anybody else with a job, we should be making some money. It's really a long-term game. So we're going to make most of our wealth later on, but we have some now. And yes, I believe in this space, so I want to invest in it. I am interested, and we can talk about this too, but I am interested in diversifying out of multifamily, because I'm all in on multifamily. So while I don't have a ton of money into it, because I don't have a ton of money, all my time and energy and everything, I own a good, a chunk of our buildings. And so I feel very invested in multifamily, but even with some of my money, I do like putting it into our own deals. One, I believe in them, so I feel like it's a good place to put our money in. And then our investors like to see that, if it's good enough for their money, then probably should be good enough for my money. So, yes, I have done that. I didn't do that early on. We didn't really feel like we were in a position to be able to do it. When you're an entrepreneur, and when you're kind of I still feel like we're getting our business started. I mean, yes, we've been going for a couple of years now, but still feels very much like we're just getting started. And so we do have to hold a lot back, because and I'm getting too far into this now, but when we get a property, it's us that's putting out all the money. It's our money, so we have to have a lot. And we may not get that back. I mean, if we were to not close on the deal or something, we could lose a lot of money in some circumstances. So I'm not able to invest passively like I want to yet. And I haven't been able to like get into the diversification like I talked about, but with some of the money that we do have, we've been happy to invest in our deals passively on the LP side, right along with all the people we bring in to be LPs on our deals.
I love that. I have, and you and I both have so many friends that do this where, it's nice to be passively invested. If you already believe in the deal, you know the deal, you love the deal, you've already sold yourself on the deal and you've put your own money down and into it and signed on the dotted line, like, why not collect all the upside of the passive side of things?
Right.
That is awesome. Oftentimes it's overlooked how much liability active investors have. And while I wasn't intending to really go down the active path at all, you really touched on that. And you're talking about the substantial amount, we have to have capital, and typically a substantial amount of capital in order to even acquire a deal. What does that look like? And let's just explain that for the passive investor who might say, they might be looking at a deal. Maybe they're looking at a deal with a newer syndicator who, conscious investor, if it's a newer syndicator, please make sure that you're partnered with somebody who has a really strong track record. Or even if that is just someone that they have a mentor, direct access to, who is really invested in seeing them be successful. Please do that as part of your due diligence. But if you're looking to invest with a new syndicator, you're thinking, well, why aren't they putting their money in? Why aren't they putting, $50,000 in on the passive side or into the deal at all? So let's talk about some of the money that, like active syndicators actually put into deals.
Yeah. So there's a lot of upfront money. I mean, it starts with the earnest money. So once you get under contract, you usually have like 5 days to put up anywhere from 1% to 2% of the purchase price typically. So, and I guess that's on the size deals I do. Maybe on the much bigger deals, it's not quite as much. But for us, 1% to 2% may be, $50,000 to $100,000 that we have to put up. So we're not going to take that from investors because we just got under contract. So that's our money. So the deals that we've been doing, it's $100,000 that we have to put out. And then our syndication attorneys, that costs $10,000 to get all of our documents put together. You got to pay for your professional inspector. We have at least one professional inspector come out. Then we may go get specific things like drain lines and stuff like that, or roofs looked at. But that professional inspector, that's anywhere between $1,000 and $2,000 to have them out on the property for a day or two. And then your bank wants you to put up some money. You got to pay for the appraisal, which all happens before closing. I think our last one, that was like $4,500. So, you can
more
see
than your more than your residential home, conscious investor, far more.
Yes. Yeah. So, I mean, you can see all of those costs. I mean, we're at, over $115,000. So that's us on the GP side, putting all that money out. So yes, we should get all that back, but we still, even when we get it back, we need it for the next deal. We need to do the same thing. So even though we got it back, we got to hold on to it if we want to do another deal. So we do take an acquisition fee so we can make some money, but that it's kind of just our salary. It's not really a whole lot above and beyond that. So it's not like, well, I'll take a quarter of that acquisition fee and live off that for the year. At least not for me. I mean, we're not doing big enough deals for that to be the case. And then even when you get into bigger deals, you're probably splitting it up a lot. So it still may not be a whole lot more, but that's kind of a salary. And sure, you can save up some of your salary over time, but it's not like we've got a bunch from that we can throw back into the deal. But yes, there is absolutely risk. All that money, if you don't close on the deal, you should get some of your earnest money back. Hopefully in today's environment, you get it all back.
Right.
That's one nice thing I like about how the environment has shifted, because we did a couple of deals where that 100, we would have lost all 100.
Did you put it down hard?
Yes.
And conscious investor, if we put money down hard, that means that if you walk away for any reason, even if it's because you found a problem and it's the seller's problem, you just signed a check over. The moment when we talk about money going hard, you just signed all that money over. to the seller. Okay.
Yeah. Yeah. And I don't want to say I won't do that again, Julie. I would say on the last couple offers, we have not offered that. Again, luckily it's not as crazy anymore. I mean, prices are still pretty high, but there's not near the hysteria around it. But the other thing, Julie, that I think even the sellers understand is that banks are way different today than they were at the beginning of the year. I mean, a huge reason we were comfortable putting up hard money was because we were so confident in the financing we could get. I mean, banks were like, yep, here's exactly what we'll do. You know, interest rates were steady. Interest rates are not supposed to double in 6 to 8 months like they have. Gosh. This is historic what has happened. But I do not feel confident at all that I know, hey, if I go to talk to a bank today, 2 months from now when we close, it's going to be the same. It feels like, no, it may not be the same. Now, I think this is a unique time. I think we'll go back more to something more normal. But right now, we would not do that. So you just got to be really careful. Like you were saying before, Julie, really important point. If you're new, if you don't understand the debt markets and things like that, partner with someone who does, because that's one way to really lose your shirt when you think just because a bank said they're going to do this, that 30 days or 60 days from now, they might not change their mind. It can happen. They can do whatever they want. What are you going to do to them? You know, so just be really careful doing that.
It's not just like it can happen. It is happening over and over and over again right now. I have some people, some friends, and, they're on their third bank, if they're going to close and it's like, nope, day of closing, can't close. Like, and we wonder, how can you do that? If we just said, no, we're walking away from the deal, like there would be a lot of consequences. And yet the banks can just say like, no, we can't do that now. Things have changed. Sorry. Yep. It's like,
well, in ours, what happened to us on our last one, we ended up closing in May. Again, that was, it was really, March and April, if I remember right, the interest rates really started climbing and then started going pretty fast. And so we just saw, like, it just felt like overnight, the bank we were working with, this was our third loan that we had done with them, third loan in a little over a year. And so we just felt so comfortable and confident with them. And it just changed. It all changed. I mean, never before had they done this, but a week before closing, they said, we're raising your interest rate on the loan 0.5%.
Oh my gosh.
Yeah, that was a big deal.
That could totally kill a deal.
It can. It was $22,000 of cash flow per year. So that's, and so we had to go back to our investors, our passive investors, and tell them this is what just happened. The good thing was over those 2 months, rents were rising, it was a good environment for that. So we felt like we could show that it offset, and it did. It's, it's a great deal, but that's just 0.5% rise in interest. So this just shows you how crazy things are today with the rise in interest rates. We went from we were at 3.875 and we went to 4.375. So just that 0.5%, again, this is on like almost a $6 million deal, $22,000 of cash flow. Just instead of giving it to our passive investors, we're giving it to the bank every year. I mean, that's and that's 0.5%.
Just half.
We're up off of that 3.87, we're up 3% off of that. So, times that by 6, we're talking about, I don't know to equate to this, but over $100,000 of cash flow if we had to go get a loan today. So just shows you how important, how big of a deal interest rates are, and why, the market and the economy are reacting so negatively to it. You can see just on this one little $6 million deal here in Cincinnati, Ohio, what a big deal that is. And the other thing they did, Julie, again, week before closing, had never said a word about holding proceeds. They said, we're going to take $180,000 and we're going to put it in a separate account of our money, like the money that we were going to have in our account. They're like, no, we're going to take 180,000 of it and we're going to put it in an account and hold on to it for a year, just to make us feel safer. So that was a really big deal as well. Now, it doesn't take money away from our investors the way the interest rate does, but that was money we were counting on to like float the CapEx stuff we were going to do and things like that. So those are some of the risks involved when you're on the active side and you got to put the money out and deal with the banks, because like you said, Joel, I mean, they can just walk away. They can say no.
And they can say, we're just going to keep this $180,000.
Yeah.
Because they just don't, like it is heartless, really. They just don't care. It's interesting because they do care. On one hand, they care about the business plan and they want to know what you're going to do, but then they almost sabotage the business plan by saying, hey, we're just going to keep this money that you're going to use to execute your business plan. No big.
Well, yeah, maybe it's like they're refining us by fire. Like, okay, if they can get through this, then they'll be able to take it down. Like if they can handle 0.5% higher and us hold on to 80,000, if they can figure that out, then it'll work. I don't know. And because we had to go raise more. So we had to, again, let our investors know, hey, because we were going to close with like, I don't know, maybe $220,000 in our account. Well, now 180 is gone. So now we got 40,000. That's not enough. That's not enough to
that's not safe.
Yeah, we have a rehab loan with that bank, but when somebody comes out and does, $50,000 worth of work, upgrading, we were putting on new decks at that property. We're putting in new windows. So they may be doing $200,000 or $300,000 worth of work. Well, they want paid every once in a while. Well, it's not so easy just to send their receipts to the bank and get it. So a lot of times we're going to pay them 50,000 and then we go to the bank and ask for 50,000. And so that's why we need some of that money. So we end up having to raise, another, we did another 60, I guess is what we did. We raised an extra $60,000, brought on like 2 more investors in that deal.
That's not too bad, but conscious investor, you're hearing this. And I hope what you're hearing is, wow, there's a lot of thoughtfulness. There's a lot of risk for the active investor to protect and to ensure that your investment is really protected and positioned well to grow. A lot of thoughtfulness. Now, when you were thinking, let's talk about closing dates. I don't know if I know that you've seen this because you and I are in the same world. It's we both hear from different people, about, the closing date just gets put off. And so, I could speak to that, but I would love to hear your perspective on what you've seen with that, either in your own experience or with other people's experiences, because oftentimes it can feel like passive investors, they will see, okay, here's the funding date and here's the closing date. And we kind of treat it like when we're buying our primary residence, we just kind of treat it like, oh, that's the date it's closing and it's going to close maybe a couple days off, maybe. But sometimes apartment complexes can close months off, a whole month or 2 months later. Let's talk about that a bit.
Yeah, I have never closed in 60 days. So, and that's even when I've sold too. So it's not just my fault. Maybe it's because there's been other buyers. It's the bank's fault. It's the bank's fault every time. It drives me nuts. I've never closed in like maybe more than 75 days, but that doesn't mean I'm any better than the people that, it takes 90 days or 120, whatever. Like, it just, different circumstances, it's going to happen to me at some point. But no, you're absolutely right, Julie. We really have no control over it. Within the first month of during that 60-day period where we're trying to close in 60 days, during the first month, we're doing our due diligence, we're doing the inspections, and we're giving everything to the bank. And we'll schedule the appraisal really early. And you feel like when that appraisal comes back and you're done with your inspection and everything's good, like you feel like you're on easy street.
Right.
And what's always happened to me, and we'll get the appraisal back maybe 2 weeks before closing. And that's all the bank's waiting on. They're just, okay, it appraised. All right, we're good. And during those last 2 weeks, this is what drives me nuts. They all of a sudden start asking for just random stuff that I've had all along. I'd be happy to provide it to them, but they've never asked for it. And it just suddenly occurred to them that they need it 7 days before closing. And I'll give it right to them, but it's just, oh, okay, we're reviewing it. And I don't know. It seems to me that like, they have enough going on where they're only actually looking at a deal in the last week. So we're working for 7 weeks. And then in that last week of the 60 days, that's when they actually start looking at it. And so all of a sudden they go, you know what? We'd like, this makes a little, let's get a little more information here. Hey, what about this? Hey, but it's all in the last week. So, a lot of times answering their questions and getting them information and maybe doing this or that, or you're waiting on them. And some banks, we mostly work with smaller banks and credit unions that are here local. There's times like they meet once or twice a week to talk. The board does. So if it's Thursday, it's like, okay, I got that to you. Can you get me an answer tomorrow on Friday? Oh, no. We meet on Tuesday. So it'll be next Tuesday that we look at this. you got us. And so it drives me crazy. I don't know why you had to bring it up, Julie, because I like my blood pressure's going up now. We got to talk about this, but yeah, it's really, I mean, not to say that sometimes, the sponsors don't mess up or something, but I would say most of the time, to me, it's out of their control of how soon it closes. And that's why one thing I would caution your passive investors, Julie, is maybe ask your sponsor, or look at the if you can see the term sheet or something, or I guess more the contract. Probably not going to show you the contract. You want to make sure that they have an ability to extend, and we always make sure we have that, because I tell the broker or the seller, look, I can promise you we will be ready to close in 60 days, yes, but I am pretty sure the bank will not. So, we're just going to be sitting around waiting for the bank, but I need the ability to do that. So you want to be able to extend.
Yes. And having 2 extensions is really important, and maybe even 3 at this point, just because the lending side is so volatile. Right. So how are you, as Threefold is looking at, acquisitions? I mean, I know that you're always looking, just like we're always looking. Everybody's always looking. And this is why, conscious investor, when we have deals, once you find operators that like and trust, when they have an offering, you jump on it, because you don't know when the next one is going to come, because good operators are very meticulous and very particular. And pretentious. I'm throwing that in there. That's my word of the day. And pretentious about the type of deals that they are offering. And so as you are looking and you're underwriting potential opportunities right now, since we're talking about the interest rates, how are you compensating for the interest rates fluctuation?
Yeah, I'm definitely as conservative and just cautious as I've been, probably as I've ever been. It's hard for me to wrap my mind around that interest rate. Prices have definitely come down, where we're at here in Southwest Ohio and kind of the surrounding area. Prices are down and sometimes way down, sometimes 10, 15, or even 20%. But I mean, just as that example showed you, we truly do buy for cash flow. So, I would love, that, we bought a $6 million building. Hey, maybe today, if we bought that same building, it's 5 million, but that's great, because, hey, someday if we sell for 8, we're going to make 3 million instead of 2 million. I get that. And that's great. I don't want to discount that, but what makes me sleep well at night and what makes me comfortable taking people's money is the cash flow. And as I explained with, just our 0.5% rise in interest rates took away $22,000 of cash flow. You can imagine, we go up three percentage points and, 6 times that, we're talking about, $120,000 of cash flow or whatever it would be. So I'm not seeing good cash flow. It was difficult to make deals work when we were incredibly hot at the beginning of this year and end of last year. And yes, again, prices are way down and it's not nearly as hot. There's not nearly as many offers. I mean, I have more and more brokers calling me, like fishing for an offer, asking me to offer, which, just never happened so much before. But the cash flow is not there for me. So that's what I'm seeing based on interest rates. I am long-term very, very bullish on real estate in general. Again, I focus on multifamily, very bullish on multifamily. I do have a confidence, Julie, that even if we bought something today that I think, prices are going to go down more, I think it's going to be worth more in 5 years. I think it's going to be worth a lot more in 10 years.
Oh my gosh. Yes.
But at the same time, again, I just go back to the cash flow, and we want to be conservative with raising too much money we want to bring on more passive investors than we have to. We want a couple $100,000 in our account for a rainy day. We've experienced tax settlements that suddenly take $100,000 from our property and things like that, or, just unforeseen things. So when you do that, when you raise too much money, when you raise a bunch to have in a rainy day fund and your CapEx fund, returns are lower. And so that cash flow is important. And it just makes us feel comfortable. If we've got good cash flow, then we don't care what the market does so much, because we're cash flowing very well. So there's no timeline, and we get, good fixed rate debt for 5 years. So we don't want to be forced into anything. I truly believe, what they say is true, that the only time you lose money in real estate is if you're forced to sell. So we don't want to ever feel that. So yeah, I'll just say, sum that up. It's really difficult to me right now to find good deals. I see people being creative today when they haven't done that in years, because you just go get your bank loan, and because bank loans were awesome and now they're not. I think that's great. And I don't want to be too bearish, Julie, to make your passive investors think that there's no good deals out there. We did put an offer in on one that was across the street from a property that we own. Felt like pushing on that, but just still a couple $100,000 off of the purchase price that they end up going with. But we're fine just sitting there. I think I am pretty bearish on the economy. I do think we're headed for recession. So real estate does very well in a recession again. So I wouldn't be scared to buy something right now, but I still think of that. I still put that into my my forecast and my underwriting, my pro forma. It's still going to show that I don't expect rent growth, for the next year, maybe two. And that's very different. Before we were always projecting rent growth. And for the past year, I've projected a lot of rent growth, because that's what we were seeing. And there was no reason to think that was going to change. But now I think there's reason to think that's going to change. So we're pretty conservative, which makes it hard to compete.
That's interesting. That's really interesting. So many things there. I know that I'm raising, we both have our own little analyzer tools that we use to underwrite our deals and everything. And I will throw in like different scenarios just to find out, like, okay, well, if the interest rates spike by the time, because you put in your letter of intent, your LOI, as we call them, right? And, you put that in, by the time it's negotiated, accepted, and it's funded during those 3 months, or, at least 2.5, really it's 3 months at this point for most people that I'm noticing. Okay. During that time, interest rates could completely shift. And so I'm looking at different scenarios. Okay, well, if the interest rates do this, what are the feds doing? How is that going to affect things? Will this deal still work? Because I don't want to go in and invest a bunch of, hard money, because you're not going to get that back. If you're paying for inspections, that's money that's just gone. It's not coming back to you in any way, shape, and form. Right. So, yeah, that's really interesting. And I wanted to circle back to something you said about over raising. And I wanted to speak specifically to you, conscious investor, to let you know that if this is a new space for you, you might hear that and you might be like, oh, they're over raising. And so that's going to dilute whatever my investment is. It's not going to be as strong. No, they're over raising there. It's all compensated. So whenever we structure our deals, we have so much money that we're raising, so many shares, as we call them. Right. And so, for example, on our recent acquisition in Minneapolis, Minnesota, the Olympus portfolio, we had 6.5 million in shares, or that's how much we could raise total. And we're not going to raise more than that. Right. And so it's just like, I think it's good to kind of say, okay, this isn't, when we're raising, we know exactly how much we're going to raise in general. And then we come into situations like that, where you're like, things have shifted and you're like, okay, let's bring in just a little bit more, so we have reserves. But in general, the returns that you see in any solicitation, in any marketing campaign that you see, those are based upon the full amount that was projected to be raised. So nothing's going to shift on that. Yeah. Great point, Julian. What I meant is, like, the broker is telling us, hey, the return, look at this. This is like, 8% cash on cash in year one, because on that $6.5 million raise, they're saying you only need to raise 5.5. Yeah. And that may be true technically, that that you could close the deal with just 5.5, but it would be really risky of you to do that. So you make a good point. And I think, your passive investors should think about that. You don't just want to look at the returns, because yes, if your sponsor raises the bare minimum, their returns, their projected returns will be better, but there's more risk involved for sure. So that's why, you got to think about a risk adjusted return. And you look at a sponsor that, when I say over raise, I don't mean we're raising more than we told our investors we're going to raise. I mean, the broker's saying, come on, you can take this deal down with 5.5 million. And we're saying, we'll go ahead and raise 6.5, because, we want to have a rainy day fund. We want to have a CapEx fund. We don't believe you that nothing needs done at the property, things like that. So you want to raise the 6.5 million. And yes, it
sure, returns are not as good if you raise 6.5 as if you were only raised 5.5, but much higher likelihood that you get your returns if you raise 6.5 and you raise 5.5, right? So yeah, very important. And you don't want to just look at, who's got the highest IRR. That's, not wise, I don't think.
Okay, let's speak to that because I'll tell you, hasn't happened too often, but I have come across a few limited partners, passive investors, and conscious investor. I'm using these terms because some of you, it's like we want to make sure we're familiar with these terms because people are going to talk in different ways. And you want to make sure that you are definitely familiar with them. So oftentimes, or I shouldn't say oftentimes, I've had a few passive investors where they're looking at a few different opportunities. And as they're looking at those, like, well, this one, well, for example, let me be very specific. We were working on 120 Class B units in Des Moines, Iowa, and we closed on that in March of this year. And it was very interesting because we had a 1.83 equity multiple. So conscious investor equity multiple, that's what we're expecting to do with your money through the hold. Are we going to double it? No, that was almost doubling it, but not quite. And I actually had a few passive investors say, you know what, this deal over here, they're showing me that they're going to do like 2.15 and we're going to go, with that. Now they may like the operators better. There might be a better relationship. There could be a lot of reasons, but Lee, you have a really great point. Like just going off of these numbers, those numbers, are a great starting point, but those numbers are only as good as the people backing those numbers and people that are giving you the most conservative numbers. I know our projections, and similar to you, it's always, let's be really clear with where these projections are, because in my mind, it's always worst case scenario. This is how I'm seeing, maybe not worst case scenario, but this is not the best case scenario for sure. Yes, and that's where you want to be, not with the person that, well, they raised the bare minimum, I got the $5 million raise, we can close this. And, we might lose the shirt off our back because we're going to get, a tax, bill that we weren't expecting or something.
Yes. Yep. Well, and then the other thing too, Julie, when we're underwriting, we can pull a couple levers and change that equity or that, multiple so easily. I mean, if you look at that other guy's underwriting and they're at 2.15, maybe they're projecting to sell at a 5.5 cap, whereas you're projecting to sell at a 6 cap, just a 0.5% on the cap rate. And for, passive investors that may not know that, just what they're saying is they're just going to sell in a really, really great environment. And Julie's saying, well, the environment might not be that great when we sell. And if you guys just flip-flop that, your equity multiple, that's you're going to be at 2.15 and he's going to be at 1.83. So there's little things like that can change it. And I mean, maybe they're right, maybe you're right, but you just need to know that that's why it's 2.15 and you're only 1.83, because they're being more aggressive on how great of an environment it'll be to sell in 3 to 5 years. And nobody knows that. So you just want to kind of look at those things. There's a few levers that you can pull that changes the IRR. It's very easy to make that look really good.
Yeah, it really is. And actually that can sometimes, if I have a head cold and I'm underwriting, I might want to get lost in a deal a little bit and be like, oh no, we can make this work. No, I would never do that. Yeah. But I mean, it's really easy to make a deal work. And anytime, I know I'm speaking for both of us. That's pretty confident. I know, but it's like, if we're trying to make a deal work, it's not a deal. Done. Get out of my spreadsheet.
Yep. Oh yeah.
Oh, that's awesome. Lee, I love hanging out with you. And I think that this is a super productive conversation. And, conscious investor, let us know, this is here to help educate you, to support you, to help you see some of the outside of the box thinking that you oftentimes as a limited partner don't see. And sometimes when we listen to other podcasts that are geared towards active investors, these things are discussed in a very different way that maybe just might feel inaccessible. So hopefully we've made this accessible, and I'd love for you to leave. It'd be just absolutely like wind in my sails as always. If you leave a rating and review, let us know what you took from this. Let us know just like one gem that is helping you invest or encouraging you, challenging you, inspiring you, whatever that is. Lee, you're awesome. And you have a fantastic podcast. I didn't give a plug for it at the beginning, but I'm going to give a plug for Lee's podcast, Threefold. You need to go listen to that if you like The Conscious Investor. You're going to really enjoy listening to Threefold. And if you like Lee, you're really going to enjoy listening to Threefold. And so go ahead and tell us best places, and you can listen to it on any of the platforms that you love listening on. So make sure you do that. Make sure you subscribe. Make sure you rate and review. That's just a way, these are free ways to encourage people and to show that you're on board. Okay. So I love it when I can support people in quote free ways. I don't mind supporting monetarily, but there's something about taking a little bit of your time. So I guess it's not totally free. Taking a little bit of your time to just support people. It's absolutely awesome. Other ways people can get in touch with you, Lee.
Yeah. Thank you for all that, Julie. It was really kind. I'm pretty active on LinkedIn, so you can find me just by my name on LinkedIn. I'm on Facebook a little bit too. And then just check out our website. It's Threefold, REI as in realestateinvesting.com.
Awesome. Thank you so much, Lee. I love this conversation. I think it might be my favorite of this year. I'm not supposed to have favorites.
Julie. I've really enjoyed it as well. Always a pleasure talking to
you. Conscious Investor, you are amazing. And remember, adventure belongs on the trail, not in your investing. And definitely not in your personal life. So if you are feeling like maybe the stock market is a little more volatile than you like, you're looking ahead and you're wanting to really diversify, remember, we need to have that conversation. We need to talk about what your goals are. And at Three Keys Investments, it's not that we're snobby or something, but this is our due diligence. We want to know. And I'm actually, Lee, you can jump in on this. Actually, we'll just do like a little bonus conversation maybe here. And because I imagine your process is the same, and we want to have that conversation with you because I think my head cold's come into play here. But the reason we want to have that conversation with you is not just because the Security Exchange Commission wants us to, but it's because you don't have voting rights. Limited partners don't have any voting rights. You are saying, hey, here's my money. I trust you. I want you to grow this. And I believe that you're going to do that in an ethical, responsible way. And by doing that, part of Three Keys Investments, what we think is, then we need to know you. We need to know what your goals are, and we need to know what resources you have, so that when we are voting, when we're voting on different projects, on an asset, and we're maybe even discussing, well, should we refinance this or should we sell this? What should we do? Yeah. If we actually know you and know what your goals are, then we can advocate for you. And so this isn't just hop on a call. This is because we actually care and we want to get to know you. Lee, I imagine you're very similar, but chime in if you want.
Yeah, I would love to. No, it's a very important topic. We want to make sure you get in the right deal, so that we're really just rowing in the right direction or in the same direction, because if it's a deal that we think we're going to sell and selling for you is just not what you want to do. You want to hold long-term. You don't want the tax implications, and we want to put you in the right deal. So things like that. But it makes me nervous, taking people's money, and investing it for them. I take it very seriously. And so, but I feel a lot better about it when I feel like, well, we have the same goals. We want to do the same things. They trust me, and I know I'm going to do everything it takes. And if we have to hold a little bit longer, they're okay with that. I want to make sure that's the case. It's an illiquid investment. That's the biggest difference between what people are used to, is that we are going to hold on to it. And if you are going to get a little shaky because you don't know me that well and you don't really trust me, and you're going to get shaky a year from now, want your money out, it's not going to be a good fit. So we just want to make sure we put you in the right deal and that you trust us and that we're going to be rowing in the same direction, so that if things don't go exactly as planned and we have to hold a little bit longer, we already had that conversation. We're going to feel good about that.
Yeah, those are really great points. And yeah, while holding for, anywhere from 3 to 7 years is illiquid for that time, many of you are investing in 401ks or Roths or some type of
Very good point. Yeah.
retirement vehicle that is also illiquid. And so you're not accessing that anyway. And if you haven't looked into it, you can also oftentimes, but not every time, roll those funds over and invest through your retirement accounts.
Yes.
Now, there are some people that cannot do that. I've come across. So, it's a conversation to be had. I definitely have access to companies that I have relationships with, that I know, like, trust, and personally use, that I can point you in the direction if you want to explore that as an option, because that's a powerful way to get started in real estate investing. If that liquidity issue is feels uncomfortable, you can just take a portion of a retirement account and roll it over and begin your investment journey in that way. So lots of different ways. What a great bonus conversation.
People should do that. Diversify a little bit.
Yeah.
It's a good idea.
Good golly. I agree. Please do that. So make sure, as I was saying, adventure belongs on the trail, not in your investing, not in your personal life. And we've had this great bonus conversation. If you are looking to start that relationship, so that we can have that relationship, so we can understand what your investment goals are, so that I don't suggest our ground up development deal, but I do, suggest maybe one of our cash flowing opportunities, right? Different investor profiles. Or if you're looking for taking life to the next level through performance coaching, please make sure that you reach out. You can find a link to Three Keys Investments and my calendar down in the show notes. Until next time, conscious investor, live big, love bigger. What's the big deal about investing in apartments? Why is it better than investing in a slew of single-family homes? I've compiled a lot of information on why investing in a multifamily, also known as apartments, will help you reach your investment goals. Head over to threekeysinvestments.com and download the Why Invest in Multifamily guide today.